I welcome you all. Today most likely will be my final class in this course. And in the end, I would like to at least know you, and therefore you will be asked to switch on your videos. This is I am telling you in advance. Okay. You know that in the last lecture I discussed about the portfolio performance evaluation, and we discussed about various types of measures like Sharpe, Trainer, and Jensen measures. These measures are commonly used in evaluation of the portfolio performance. And when we call it portfolio, then naturally the fund performance like mutual fund, hedge funds, and others. In the today, I'll start with some aspects of global portfolio diversification. It means that if you are making investing across globe, where the not India but the entire world, the universe is the entire world, you know. So now, as you know it very well, that in the second unit we discuss about the return and risk trade-off. We started with Markowitz, Frontier, and like that, the risk return possibilities. The more we are here, for example, if the risk is there, given the same level of return, for example, if a stock is this much, risk is this much, giving this much, and this is giving this. So naturally, this is better portfolio than A is better than this. And then we introduce this the efficient frontier plus risk-free rate, and we discuss about the market line, CAPM, capital market line, security market line. And they are in a worst case beta, and all these are the risk return possibilities which are there. When we are diversifying across globe, then what happens that the number of assets which are available for investment is quite large, and therefore the choice set is much larger, and that is why it offers the opportunities for better risk return diversification than domestic security. And the word here greater diversification opportunity means that this is the example which I took it. That if maybe in domestic market you are only getting this much at this level of risk, and this is the R1 return. So if the global investment may offer you a same level of risk, higher return. And that when you are making investment globally, then there are various factors which may affect it. For example, say later you have made investment in Latin America. Now, it is not necessary that the business cycles of India and the Latin America, that is the fluctuation in activities, they are similar. Maybe a country like India is not performing well, but other countries are performing well. So therefore, what happens that the global portfolio diversification offers better opportunities for diversification, and therefore it may be beneficial for global portfolio investment. But there are various issues in the global portfolio diversification. The total amount of investment across globe is very less, not more than 10%. The entire investment only 10%. So So there are so many factors why when global portfolio offers better investment risk return opportunity, why people do not make investment across globe. So this puzzle in finance is known as home puzzle. The people by and large confined to their home country. There are various reasons have been offered. One simple reason is that people, they know the companies which are, domestic companies, they know better it and like that. And other reasons are that when you are making investment across globe, there are various kinds of risks which are involved. Number one is political risk. Maybe the political stability or risks which may be there, which may affect the investment. In extreme cases, certain government, they have, appropriated, they have put restrictions on, the inflow, the outflow of the funds. So, and when the political, dispensation changes, there are changes in policies. So there is always likelihood of the investment across globe getting. Then currency risk, I have already told you. When you are making investment across globe, then exchange rate also comes in the picture. And if the country where you are making investment depreciates, then the return in maybe neutralized or may not be beneficial, because the gain in higher return may be affected by the fluctuation exchange rate. So that is why this is also another important factor. The custody risk I have explained to you. Custody is that in extreme cases, government, what they do, that they expropriate the assets of that, so that is extreme. And then liquidity risk is also there, that sometimes investments are very difficult to dispose of, and when you dispose of the investment or sell off the investment, then it results in heavy loss. So liquidity is that you can transact at lower buying and bid and ask spread, that is the rate at which you can buy and sell, should be very narrow. So in some cases, there is liquidity problem. And one of the issues, especially in financial crisis, was that there was a liquidity shortage. When you sell too much in the market, but then it creates a problem. The liquidity flight is there. And the kind of fire sales comes in, so that may be another factor. And global portfolio, there might be too much risk also, when you are getting too much return, so it may be volatile. So in that sense. So these factors, they have been pointed out that they may affect the global portfolio. These are explained here in my slide, and you can go through these things. Okay. So, but I will stop here and we'll go on to discuss the last topic in your course, that is options. That in the beginning I had, while talking about financial securities, I had discussed, three types of securities, you may recall: equity, fixed income, and third one I have discussed, derivatives. So this I had discussed, and this part I had explained to you, that derivatives are those securities which they are derived their value from some underlying securities. They do not have any independent existence of their own. Rather, they are written on equity, they are written on bond, they are written on some other assets. So that is why their value moves in line with the fluctuation in the underlying assets. And two basic building blocks of the financial derivatives are options and futures. So in international finance, you may have studied about futures. Future is obligatory, is very similar to this. And future contract, which gives the holder obligation to buy, and it's not voluntary. Whereas option is asymmetric type. So that is why the word derivative is. So I will discuss about equity option, what it is and what some of the features, and something about the pricing of options also. So let us take a definition. An option is a contract which gives holder it's the right, but not the obligation. It is not obligatory to buy or sell an asset at some predetermined price within a specified period of time. This is a general definition. If you say that in equity option, then to buy or sell an asset in equity at certain, so the right to buy is called call, and the right to sell is called put. And if you are holding a right to buy, it is called call, and at a predetermined price. Predetermined means that price is specified and during certain period. So there are certain terminologies also with the option. Let us go through them. So this is I have explained just now. A call option is give right specified number of shares of within certain period of time. An option to sell a specified number of shares of within certain future period. And then the price, specified number of shares and price. For example, 50 shares buy a call option, XYZ company at 100 rupees. This is the strike price or exercise price. And let us say in 1 month. During let us say that is the T plus 1, we start from here. One has bought a call option, give the 50 shares at 100 rupees. Now one can buy this. Now there are options are two types variety. One is called European option. You can exercise only at this point at the end of the period, whereas American you can exercise during this period. So just I am talking about here European option. Now option price is the market price, which I just the price which you pay for having this right. This right to buy or sell does not come free. You have to pay price premium for option right. And naturally, behind any contract, if there is a buyer, then there is option writer. Okay, on other side of charges that if you want to have 100 rupee at 100 rupee, we will charge you 5 rupee per share. So 250, pay us 250 rupees for having this right. So this is called option price. And this I will talk in later part, what price option should sell. And option has expiration date. For example, in India, equity option, there are 3 types, 1, 2, 3 months, near month, middle month, and far month. So 3 types of option available. So up to maximum of 3 month maturity period of different strike prices. Not only one strike price 100 rupees. It may be lower than that. It may be higher than that. It may be like that. Very available. And in individual stock, not every stock is given the permission for trading in option. Exercise the value of option if your exercise current stock price minus. For example, if you have bought it option of 100 rupee and this is the exercise price and stock price is 105. So the difference is the 105 minus 100, 5 rupees the exercise value now. If you exercise now, you will get 5. Now, during the life of the option, the option may move or may be profitable. For instance, if you just take it exercise price 100 rupees and price may move, it may go up, it may come down. Okay. In call option, the right to buy means that you can buy it. For example, if price move, of the stock moves greater than 100, then you will be profitable. For example, if you're going to buy in the market, maybe 105 rupees, but if you exercise this thing, you can buy at 100 rupees. But in market, if it is lower, then it is no point. You lose that option price premium which you have paid it for getting this right. So that is why option is profitable only when exercise price is lower than market price or market price is greater than the exercise. For example, exercise price is 100 rupee, market price is 105. Reverse it, market price. And in put option, it will be profitable only when exercise price is greater than. Just replace this, put it here, put option. Put option means the right to sell. It is a kind of downside risk or insurance against the fall in price. Now, if you have bought, the put option and it is 100 rupees, you can buy it. And if exercise is, why you have bought it? Because you think that the price may go down, isn't it? May fall. And therefore, when you sell in the market, then you will get lower price. That is why you have bought. So it will be beneficial only in the event of fall in price, not in the rise in price like in call. So that is why. So if a stock price is, has increased, then call put option will be worthless. You will sell at higher price in the market. Why sell? But if the price has fallen to, let us say, 95 rupees. The price has fallen to 90 rupees, then then it means that if you sell now the option at 100 rupees, then in the market, if you sell it, then it will fetch you only 90 rupees. Whereas by putting put option, you have got the exercise price, so it will be you will get a profit. That is why it is written there, exercise price is greater than market price, 100, and market price is. So these options which are profitable, they are called in the money options. They will be profitable. Out of the money option is that when Marshall is not profitable. If call price, exercise price is greater than the market price. For example, if the exercise, that is right to buy, exercise price is 105, market price is 100. So there is no point. You will buy from the market. And put option will be worthless. Exercise price is lower. For example, it is 100 and market price is 105. Why you will sell it at 100? You will sell it at 105. That is why. And in the money option is that when exercise price is equal to stock price, so it will be neither profitable nor. So these are some of the option, when it will be profitable, when it will not be profitable. This I have already explained to you that American option, there are two varieties of option. American option can be exercised any time during a particular, either during this period or at the end. Whereas European option can be only exercised if it is 1 month option at the end of this, not during this. So this is the difference. Intrinsic value, the profit that can be exercised immediately. When you buy option and when you exercise immediately, the profit which you will get is called intrinsic value. Whereas, for example, if you buy option now and you exercise right now at this, today is 24th of February or whatever. So if you exercise now immediately, it is called intrinsic value if it is profit. And at the end of, like on the expiry of this period, when you exercise it during this period, option may move from in the money to out the money because price fluctuates during this period. So it may move. So that is why the time value, the difference between option price and intrinsic value, during this lifetime of the option, the value of option may move because of so these are some of the I think that it has come at times. So now the same thing can be explained here in a graphical form. Same thing has been written in symbol. If payoff is strike price minus exercise price, just put a number here, 105 minus 100. If it will be profitable, if it is lower, then it will be 0, because you will lose the premium which you have paid. Okay, so payoff is minus purchase price. Purchase price means actually the profit will arise. For example, if you have purchased at 100 rupee, and you are getting here, for example, 5 rupee profit per stock, but you may have paid 5 rupee option premium. So actually your profit is 0. So that is why it is written here, payoff minus purchase price. Actually, your price will start after that because you have lost for purchase, is because of this. Then payoff of put option, I have already told you, it will be profitable in the event of fall in price. So that is why it's right to sell. So if stock price is greater than the exercise price, so why one will, for example, if one has bought again at 100 rupee and stock price is prevailing is 105, it has already gone up. So why you will sell at 100 rupee to option writer? You will sell at 105 in the market. So that is why if the stock price is greater than, the option is worthless. 0, you will lose the option price premium which you have paid. And it will be profitable only when the stock price is below. That is why it is written X minus F. In call option, it was like this. Here it is profitable is that it's exercise minus the price minus the stock price. So payoff will come the option. If it is profitable here, for example, 5 rupee and premium is 3 rupees. So then price or premium, this is called premium or price, which you have paid it for to option writer, 2 rupee profit. So after you take into account the premium. So this is how the option premium. Now the same thing has been explained here in this way. Now payoff a call option is here, for example, exercise price is this is given. So like call option is there. If the right to buy, I'm writing here. You have, let us say, 100 rupees. Okay, exercise price, stock price moves beyond this. So if you buy in the market, so it will be, you will pay up. So this line gives us the payoff. So that is why difference will be the payoff to the call option. Similarly, for this exercise, this is, for example, if price is lower, that is why this area will give the payoff to the option, because in case of if price is higher, beyond this, so why you will sell at lower price? You will sell, let us say, 105, 110. So that is why it is like this, the payoff is also shown. So now the question is, that these are some of the terminologies which I have discussed here, that how payoff, that where complex strategies are also there, where you combine one put and other call, same strike price, different strike price, different maturity. There are various options, butterfly spread, straddle is there, bear spread is there, bullish spread is there. Combining two type, you buy, call and put on the same buy and different strike price. So various kind of, a product can also be combined to arrive at the payoff. And this gives an example of the innovation in financial products. Mix two products, you create another product. Now, the price of option, what price, should be charged for providing this right by option writer, premium. For example, give the right. So what price should be charged? Now, here the most important thing is that, premium, the option is that what price it should sell the option, what premium should be charged. Now, this was a very difficult problem, and that various economists, they try to solve this. What should be the option price? Since 1900, only happened in 1972 the breakthrough came, which I will explain to you later on. The formula came for option price. But as I said that you can combine, one call, another put. Call of different strike price, call plus put, same strike, call plus different maturity period. And now you see that if you are combining these things, so the different kind of payoff, for example, if you are same call and put on same, if you are losing from this, you may gain from this. So you have, or you combine call plus equity stock. So you buy, you buy a call option and equity, or let us say so you are, what you are doing, that you are trying to create a different, a new kind of product by combining this. So this is just a brief, this is just a hint at what we know as financial engineering. Like engineers construct bridges, financial engineer construct financial products. For example, you want to have this much payoff, they can mix and combine it, and they can come up with the new kind of product. So financial call and put option, and like this. Now this pricing relationship, and to get an idea about what this relationship may turn out to be, let us try to understand put call parity theorem. Now put, that the right to sell. Call means right to buy. Now, in order to find out the call price, you buy a stock and you borrow money for the X amount at this rate, like how much money you need, plus you buy a put. Now this relationship can be used to drive the value of a call option. And if you know it, for example, there are, if you know this call option price is there, strike the stock price, it, the present value of a strike price, it, then you can find out the, let us see that how it works. That this does not require any explicit formula. For example, the call price is equal to the terminal value of the stock price, that is the final put option payoff minus exercise price, the amount which you have borrowed. Now let us see how it works. Payoff means the return, okay, monetary payoff. For example, if you buy equity stock, so naturally, if you buy equity stock, you will pay the amount of, S. If you say that it is 100 rupees, I'm not writing the number. You will pay it, one stock. Okay. So S1, I am writing it. So it's a payoff if you buy equity stock at 100 rupees. And if, let us say, so its price will move in line with the, for example, it is 100, it may be 105, for example. Okay. It may move like this. Okay. So I'm not writing here a number, just to explain to you. So the stock price, you have bought a stock. So as the price moves, either it may be it may fall or it may increase. And we have written here, if stock price is lower than the exercise price. Okay, it means that if you have bought a call option, sorry, a put option on this, so this is the strike, this is the exercise price. So exercise price is, let us say it is 100, okay, and stock price is now 95. Okay. The payoff, it is 100 minus 95. So it will be profitable only in this situation if stock price is lower than stock price. And you have borrowed an amount which is equal to, for exercising this. For example, for 100 rupee, how much you have when you buy it, you know that you after 1 month you will pay the amount. So what will be the present value of this? If you keep that money in a bank, that will grow at certain rate of interest, E value up to 100 rupees you will get after that, and you can. So that is why we have borrowed this amount. Now you see that in this condition, if you buy, the payoff will be, so this will also go. So in this case, the value of the call option value will be 0. Naturally, if the stock price is lower than exercise price, the value of call option will be 0. And in this case, if you see that stock price is greater than the exercise price, then you see that here, if stock price is greater, the option is worthless. Put option is worthless because one can sell at higher price. This all will be there. So that is why S1 minus E1 is the call option value. It means that the value of a call option is at least should be stock price minus exercise price. At least. For instance, if prevailing stock price is 105 and exercise price is 100, at least the price of call option should be ₹5. If you do not charge ₹5 now, you give exercise price at lower than this, 3 rupees, then what will happen that people will pay 3 rupees and for exercising, and will immediately and will get 2 rupee profit. So that is why this put call parity theorem just provide a glimpse of the concept of financial engineering. How can you combine various kind of, what has happened here is that one has bought a equity stock, one has bought a put option, and one has borrowed the amount equal. Now the payoff of this thing is equivalent to when you buy a call option. So that is why the price of option should be at least equal to this much. So this is explained here in the diagram as well. Like the value of call option is this much, borrowed amount is that you borrow this amount, combined all these things, so it will look like this. Now the point which I was explaining, that option pricing and how option should be priced, what premium should be charged. In order to drive a formula for this thing, certain boundary conditions have to be determined. And boundary condition is that please understand this thing very carefully, that if it is equity option, the option price cannot be greater than the price of the underlying stock. If any stock is selling at 100 rupees currently, you can't charge more 100 rupees, because why one will buy option, call option on this, then one will buy equity stock if you are charging 100. So it cannot be maximum price, it can be theoretically is the price of the underlying asset or stock. So that is why it is. And the lower price will be that which you charge now is the stock price, prevailing stock price, minus the exercise price. For example, if you are giving exercise price 98 rupees, at least you should charge, it should be 2 rupees. Because if you do not, then what will happen, that if you do not charge 2 rupees, then it will become a money machine. People will buy, if you charge 1 rupee, so people will buy call option at 98 and then exercise the right and get 1 rupee profit per stock like this. So at least. Now, given this, the value of call option or the price of call option would lie somewhere in between. Now, as I told you that the various economists tried to find out an option valuation formula, what price should we charge on the option. And as I said that breakthrough came in 1973 when Fisher Black and Meron-Scholz, they developed their famous formula, Black and Scholes, which was improved upon by Robert Merton. So it has come to be known Black, Scholz, and Merton formula. Fisher Black, Meron-Scholz, and Robert Merton. And Black is no more. These two people, they received Nobel Prize in Economics for the invention of this formula. And this formula actually, created a lot of, the financial innovation, financial engineering, and also it also played a, role somewhat, which was not a very constructive role also, like, the financial crisis of 2008-9, and it also said that this formula has, created havoc, also. But I will not go into that detail of that. So 1973, Fisher Black, as I said, that because he died of throat cancer, therefore he could not receive. Now the underlying mathematics of this formula is very, very complex. They have used Ito calculus. Ito was a Japanese mathematician. So they have used a calculus which is, for example, calculus when differentiate something, that differentiation is in environment which is deterministic. But if you try to differentiate in an environment where stock prices are there, then there will not be subject to determinism, because stock prices do not follow deterministic, environment. So that is why they base there is on the model. They model the stock prices on the basis of the first assumption was the stock price moved in random fashion. Then they model it on the based on Brownian motion. As those who are students of physics, they know it. And then they said that there is a the prices follow log normal, and then they solve this problem, keeping in this upper and lower bound. See, like this. So the underlying mathematics is very complex, but the formula and the import of the thing is simple, like this. So their formula is based on 5 variables. The first variable is stock price. Second variable is exercise price, that is the price at which one can. And the third variable is the volatility, which is nothing but you have already know it, standard deviation. Time to expiration means the maturity period, 1 month, 2 months, 3 months, whatever. And R is the risk-free rate. So 5 variables are there. So this is readily available. This is readily available. This one has to calculate for every stock. This is readily available. This is readily available. The only thing is this has to be calculated. Now, based on these things, they have come out with a formula which is a landmark, which is known as Black and Scholes formula. And this formula tries to tell us what is the relationship between the stock prices. For example, the higher the, please keep in mind this thing, that if it is a call option, payoff will be profitable, and if it is this, it will be this. In case of fall in price, it will be profitable. Okay. And in case of increase in price, it will be profitable. The first variable is stock price. Okay. So higher the stock price, more the value of call option. Naturally, if the stock price 105, if it increases to 110, it will be profitable. The higher the increase in exercise price, if it goes up, the value of call option will come down. Naturally, if exercise price is higher, the value of call will be lower. Lower the exercise price, greater the value of. Greater the volatility. Any volatility means that there are greater likelihood that the price may move. If any stock has very narrow volatility, the chances of an option which is unprofitable out of the money becoming in the money profit is very less. So that is why the greater the volatility, greater the chance of that the value of option will increase. Similarly, greater the time period, greater the likelihood that the call option will be profitable. Lower the period, for example, a 3-month period option is there, greater this value will be higher, call option value, than the 1 month, because in 3 months, an option which was unprofitable may become profitable. And exercise risk-free rate, higher the exercise, higher the risk-free rate, greater the borrowing rate is higher, the exercise price, the price at which you can buy. So that will affect the interest rate, because the interest the borrowing rate. So higher the borrowing rate, greater will the value of the call option. Other thing will be opposite. For example, if stock price is lower, naturally the stock price goes up, then value of call option decreases, because if the stock price is increasing, so why one will sell at this price? For example, it is 100, if it is going at 105, one will. Other thing like increase, like exercise price increases, positive increases, the value of call option, the value of put option, for example here, given the exercise, please keep in mind when I am saying this thing, then I am holding all these things. For example, if I am talking about this, I am holding these variable as constant. Okay, so do not think that I am simultaneously varying these. If simultaneously, then import of the thing. For example, given other thing, the exercise price is higher. Naturally, the price at which you can sell is higher, more will the value of. And this is same. Volatility is higher. Naturally, chances of option getting out of the money from the end. And naturally, this also same import like call option. And here is that the exercise price, the interest-free rate, lower the interest-free rate. If interest-free rate increases, then the put option value will, because you will have to pay higher amount for this, for exercising this other. So that is why these are the sum of variable and how they affect the call option. Now let us have a look at the formula. This formula is very complex. What it says, that the call option price, this is equal to strike price D1, and then this is the value of the, for example, if you have this thing in numerator, it is ERT, okay, that is we are discounting by E is the number when you continuous compounding 2.7, the natural log, and then this is the distribution, cumulative normal distribution and D1. So first we have to find out we have to take natural log of the strike price, stock price minus exercise price, R, and plus the volatility, and also these variables are explained here. The current stock price, K is the option strike, K is the natural log, risk-free rate, T is the time, and standard deviation. Now this part that this is a kind of replicating portfolio. Their formula is based on a replicating portfolio. Now this amount is that how much you should buy of a stock and how much you borrow. This is, so this difference between the amount, like that we have taken S minus E in the put call parity. Same thing is written here. That this is the how many units of stock you buy it, and how and what is the present value of the exercise price. Call option price will be equal. The at least the call option price. We have not written there D1 and D2 because the probability of the stock price movement was not taken. That is why D1 and D2 is brought here. So you know that normal distribution. Now this D1 is a cumulative entire area. This gives the value. And this is nothing but when you get the value, you subtract from the volatility multiplied by the square root of the time period. This is 1 month, or so it will be like, so we will divide by or it is 3 months, so it will be 0.25. We'll multiply by that. So in this way we get this formula, but the formula intuitive, it is the same thing which we have derived, that the call option value in simple will be equal to this. If it is not this, then for example, if stock price is 105 and exercise price is 100, call option price should be at least 5. What they have done here is that they have taken the distribution, cumulative distribution, the move, and also now they have taken, because the call option will be exercised at the time period, like 1 month is here. So they have taken what if you keep that money, if you want to exercise after 1 month, if you could keep money in a bank, how much money you should keep at this rate of interest to get E amount after. That is why they have discounted it. Like if I say that if you want to have 100 rupee from after 1 month, how much money you put at this interest rate, you will divide by this 0.05. You will say that, okay, you keep this much money. So same thing has been done, but here we have taken into account R is the rate of interest and this is the time. And this has also been taken into account, that the distribution. So what they have done is that they have, plugged here this is the end result of the formula which they have used it. Now, so this formula of Black-Scholes formula is, if you go to BSE website and other sites and all the call option and the option are valued using this formula, Black-Scholes. There are modifications in this formula, but I have no intention of taking this formula and calculation part. Okay, if you see the papers of the exam papers of final year, you will find that there are questions on call option, and you know that in order to provide this distribution fee used to supply the normal distribution table, not like simple you get cumulative probability distribution tables also. So, but at least it will require few more lectures to deal with this thing. Therefore, because of the paucity of time, I am skipping this thing. But in Excel, I have got this formula. Last year also I discussed that. So that can be taken care of. But my intention was here just to explain the logic behind how this formula has been arrived at. And you know that in foreign exchange market also, this formula is used, and there the currency option is there. Then instead of this rate, R, they take it foreign rate minus domestic rate. So this is known as Garman-Kahlin modification in the formula. And then there are other modifications also, like that stock prices, this does not take into account dividend rate. Okay. Now this formula acts as a building block for development of the formula also. But please keep in mind that, like any other innovation, this formula has also got loopholes, like volatility. Now this formula is based on some modeling, like stock price follow the log normal distribution. If they do not follow normal distribution, then what will happen? For example, if they follow, there are, for example, stock prices falls by 10% in a day. So this formula will not, and this is what happened during when the stock prices and other asset prices fell. This formula fails to capture tail this, what we call it. So that is why the formula, and there are loophole, like we assume that the certain things are constant within the. Even Black and Scholes himself wrote a paper on the finding holes in the formula. He wrote it, and this is formula, as I said, that is used for the valuation of call option. And for your information, I have guided a PhD on the empirical testing of Black and Scholes model in India, where we have taken also into account not only this first moment is the plus skewness and cortices. Some adjustment has been made that the third and fourth moment also, because so the has been added, some adjustment has been made. So modifications are going on and understanding, but you know that behind any formula, there are assumptions. And those assumptions are not valid the formula. And that is why when financial crisis erupted, the Nicholas Nassim Taleb, who has written Black Swan and other books, he said that I'm going to sue the Nobel Prize Committee for awarding this formula because it has brought destructions, And please keep in mind the formula actually developed 1973, but option trading was done before that. Okay? That is why, but actual formula was not there. The same formula, same thing is used in, you just plug the value, you will get the call option. And so this is in very brief about the Black and Scholes formula and other thing. And with this, I close my discussion on investment. Whatever I have to teach, I have already explained to you. And therefore, I would advise you now in the end that those who are attending classes, they switch on their videos so that at least I can see who they are and like this, because we never got the opportunity to physically meet. सारे लोग स्विच कर लें, आ जाएंगे सारे लोग करेंगे, थोड़ी सी बात भी हो जाए क्या.
Good morning, sir.
सारे लोग, everybody can come in the frame. 25 लोगों को ले सकता है at a time. आप लोग तो 14 ही लोग हैं. अभी कितने लोग आए हैं? 4. ऐसा कुछ नहीं है, सिर्फ शक्ल अपनी दिखा दीजिए, बाकी सारे हिजाब में रहिए, कोई ऐसा नहीं है.
गुड मॉर्निंग सर.
सो रहे हैं या जाग रहे हैं लगा करके.
गुड मॉर्निंग सर.
चलिए यश गोयल साहब, क्या आप अनम्यूट करिए.
यस सर.
कितनी क्लासेस की आपने? अपनी जबान में बात कर लिया जाए. हाँ
सर, सारी क्लासेस की ऑलमोस्ट, शायद एक का कुछ छोड़ के
मौजूद है. मैं तो ठीक
जी सर. सर सारी करिए.
तो समझ में आया कि नहीं आया?
सर आया है काफी हद तक, और कुछ चीजें हैं जो नहीं आई है, उनको दोबारा पढ़ने की कोशिश कर रहे हैं.
हाँ, तो पढ़ने की जरूरत पड़ेगी. ये ब्लैक एंड शॉल फार्मूला के लिए ना 3-4 लेक्चर कम से कम और चाहिए इसके लिए समझाने के लिए. हाँ
सर, अगर हो सके तो आप ये वाली स्लाइड्स भी थोड़ा ग्रुप पे भेज दीजिएगा ताकि आसानी.
मैं सारी आज भेज दूंगा जितनी है. ठीक है,
चलिए, शुक्रिया सर.
चलिए आप बताइए, क्या नाम है? आयशा. आयशा अनम्यूट करिए अपने आप को. हाँ, कहाँ पर आप लोग, कहाँ पर हैं ये भी बता दीजिएगा. अलीगढ़ में हैं या कहीं घर पे हैं आप लोग? घर पे?
सर मैं अलीगढ़ से ही.
अच्छा ठीक है, बस गाजियाबाद से. तो आयशा, आपने कितनी क्लासेस किया? ऑलमोस्ट सारी की है. ऑलमोस्ट सारी मतलब बहुत ही. अच्छा, चलिए आप ऑफ वो कर लीजिए, वो कर लीजिए, म्यूट कर लीजिए अपने आप को। मुस्कान।
गुड मॉर्निंग सर।
हम्म,
सर अलीगढ़ से हूँ मैं, ऑलमोस्ट सारी क्लासेस करी है।
जैनब।
जी सर, सारी क्लासेस ही करी हैं मैंने भी।
अच्छा, आपकी तो खैर। आदित्य भी काफी रेगुलर रहे हैं मेरे समझ में। क्यों आदित्य, अनम्यूट करिए।
गुड मॉर्निंग सर। यस
हाँ,
सर।
कितना समझ में आया तुम्हें?
सर काफी हद तक समझ में आ गए, और सर जो समझ में नहीं आता उसकी रिकॉर्डिंग देख लेता हूँ मैं।
अच्छा, रिकॉर्ड भी कर रहे हो?
यस सर, क्लासेस रिकॉर्ड हो रही हैं।
अच्छा, चलो ठीक। लेकिन उसको मुझसे परमिशन लेके करना, मेरी चीज को रिकॉर्ड कर रहे हो, कोई बात नहीं। ठीक
फॉर श्योर।
ठीक, चलो। आप नफीस।
यस सर।
बताइए आप।
सर मैंने भी लगभग सारी क्लासेस की हैं सर, 3 क्लासेस छोड़, 3 या 4 क्लासेस छोड़ के सर।
नफीस, तुमने सारी क्लासेस किया है?
यस सर,
कुछ
लगभग सारी क्लासेस।
अच्छा, रिकॉर्ड में तो नहीं आ रहे हो तुम? कोई दूसरे नाम से कर रहे थे
मुश्किल
क्या?
से सर 3 या 4 क्लास छुट्टी होगी सर।
3 या 4 क्लास किया है या छूटी है, ये बताओ।
छुट्टी है सर।
अच्छा, वो तो जब वाइवा के दिन आओगे ना, तो उसमें मेरे पास पूरा रिकॉर्ड रहेगा। हाँ, वो
यस
तो मैं
यस
अभी निकाल रहा हूँ, सारा जूम में सब इकट्ठा कर लिया है। ठीक।
यस सर।
और कौन कौन बचे हैं बताइए, अब शुरू कर दीजिए बाकी लोग। हमजा।
अब्दुल अहद।
अब्दुल अहद, चलिए साहब बताइए अहद साहब।
हेलो।
हाँ हाँ।
जी जी सर, मैंने तो करी है, अप्रोक्स मैंने सारी क्लासें करी हैं। दिसंबर की एंड में आकर मेरे
तो
अंकल
कहाँ
की डेथ
ये
हो गई थी,
ये
तो
जनाब, आप कहाँ पर हैं? आपकी आवाज कहाँ से आ रही है? क्या
सर
रामपुर से आ रही है, किसी पहाड़ वहाड़ से आ रही है? आप अपने आप को ऑन तो करिए वीडियो। ये ना कहिएगा कि मेरा जो है वो हो गया है, ऑन तो करिए ना। देखिए गायब हो गए हैं, पता नहीं।
हेलो।
हाँ,
जी हेलो।
नहीं, वीडियो तो ऑन करो भाई तुम। अहद।
जी सर।
हाँ हाँ। कहाँ हो?
जी सर,
रामपुर में?
जी सर।
अच्छा, हाँ, सारी क्लासेस किया है?
जी सर, 80% करा है सर। दिसंबर के एंड में मेरे अंकल की डेथ हो गई, तो उसमें मेरा एक आध हफ्ते में मेरी शायद रह गई होंगी क्लासेस जो रह गई थी, वरना तो मेरी जब से रेगुलर ही क्लास मोस्टली।
अच्छा, वो तो सारा अमान नामा मालूम हो जाएगा अभी तो, अभी तो
जी जी
क्लेम
सर,
है
जी
ना।
बिल्कुल
क्लेम है, चलिए ठीक।
बिल्कुल बिल्कुल बिल्कुल।
ठीक है, चलिए म्यूट कर लीजिए। और कौन जो बचे हुए हैं कराइए अपनी introduce
Sir,
कराइए।
good morning, sir. This is Keshu here.
हाँ, बताइए किसी साहब।
Sir, I also attended a few classes. I couldn't able to attend in the first week of January, but I
हाँ,
tried to join a past 2 weeks that I'm trying to join the classes on time. That is this. Sir.
ठीक। एंड देन हु आर लेफ्ट?
गुड मॉर्निंग सर, यूरित जैन।
कहाँ पर है भाई साहब आप? यूजित, हाँ
सर
बताइए।
आई एम फ्रॉम अलीगढ़ ऑल्सो।
अच्छा, आप अलीगढ़ गए हैं, बताइए यूजित साहब।
यस सर। सर स्टार्टिंग की क्लास रह गई थी मेरी कोविड और सर इंटर्नशिप की वजह से, पर उसके बाद से एंड में रेगुलर कर रही हैं सर।
अच्छा, उसके बाद से आपकी रेगुलर क्लासेस हो रही हैं? ठीक है
जी सर।
अच्छा, ठीक है। कौन बचे हैं? शिराज
गुड
साहब।
मॉर्निंग सर।
हाँ, शिराज।
जी सर।
हेलो, गुड मॉर्निंग
हाँ
सर।
बताइए।
सर आई एम आल्सो फ्रॉम अलीगढ़ एंड सर स्टार्टिंग की थोड़ी सी क्लासेस मिस हुई थी, बट अभी रेगुलर चल रही हैं। दिसंबर अराउंड की मिस हुई थी, बट जनवरी से आई एम रेगुलर ऑलमोस्ट।
अच्छा,
Recording in progress.
अच्छा, कुछ आप लोगों की शक्लें भी मैं रिकॉर्ड कर ले रहा हूँ क्योंकि, तो चलिए ठीक है।
अस्सलाम वालेकुम
और
सर।
कौन बचा, कौन है बता दीजिए।
सर हमजा मशहूद सर,
हमजा मसूद साहब बताइए।
अलीगढ़ से ही हूँ सर। आई थिंक 90% क्लासेस करी हैं।
अच्छा, चलिए ठीक।
ओके, थैंक यू सर।
अब शिराज बताएं, शिराज।
जी सर, हेलो।
हाँ हाँ बताओ।
जी सर, अस्सलाम वालेकुम सर।
हाँ।
जी सर, अलीगढ़ में ही हूँ मैं।
आवाज थोड़ा सा कम आ रही है, कोई बात नहीं,
हेलो।
चलो।
हेलो।
हाँ हाँ बोलो, जोर से बोलो, थोड़ा सा आवाज बढ़ाओ।
जी सर, अलीगढ़ में ही हूँ मैं।
हाँ हाँ
जी सर, स्टार्टिंग की तो क्लासेस मिस हो गई थी अच्छी खासी, लेकिन उसके बाद अब थोड़ा बेहतर होगा मेरा अटेंडेंस रिकॉर्ड।
तो चलिए, बहरहाल ये है कि क्लास, इन्वेस्टमेंट मैनेजमेंट की क्लास जो है, ये कोई अभी आप, इट इज नॉट लाइक एनी अदर क्लास के मैं आपसे कहूँ कि मैं टॉपिक दे भी सकता था, मैं कहता प्रेजेंटेशन भी हो जाएगा इस पे, ठीक है, लेकिन कुछ अभी समझ में आती नहीं। जितनी कोशिश की गई है, जितना मैं कर सकता था गिवन द टाइम कांस, क्योंकि कोर्स पूरे कंटेंट को इन टोटलिटी मैं कवर नहीं कर सकता इतने कम टाइम में सारे। अब जैसे कंपनी जो फाइनेंशियल स्टेटमेंट एनालिसिस थी, इसके लिए कम से कम 5-6 क्लासेस चाहिए जो कि ट्रू वैल्यूएशन करने में, लेकिन मैंने आई ट्राइड माय बेस्ट टू एटलीस्ट प्रोवाइड यू अ बेस फाउंडेशन। अब आप उसके बाद बाकी तो आप उसको डेवलप कर सकते हैं। एंड एटलीस्ट आई कैन से जितनी थियरीज हैं, चाहे वो CAPM हो, चाहे वो, आई हैव ट्राइड टू टेल यू अबाउट दैट इन अ वे दैट यू कैन अंडरस्टैंड। मैंने बहुत मुश्किल बनाने की कोशिश की नहीं, आई डिड नॉट ट्राई, आई कैन मेक इट वेरी कॉम्प्लेक्स ऑल्सो। तो टीचर का काम नहीं है मुश्किल बना दे। बहुत सारी ये ब्लैक एंड शोल्स मॉडल है, क्योंकि हम तो मुझे तो वैसे भी समझ में आ जाएगा, लेकिन आप लोगों को जाहिर बात देख टाइम, इसलिए थोड़ा सा देखिएगा। हिस्ट्री भी है, कुछ पहले रीडिंग मटेरियल होता था, हिस्ट्री भी डिस्कस करते थे, ये सब इश्यूज हैं। बहरहाल आपको नोट्स आज मैं प्रोवाइड कर दूंगा। और दूसरी चीज़ है कि द रेस्ट ऑफ द एंड असाइनमेंट आई हैव ऑलरेडी प्रोवाइडेड टू यू। कॉपी मत करिएगा किसी का उसमें, और ना प्लेजरिज्म का मेरे पास चेक भी है, मैं उसको चेक भी करूंगा जो आपने आंसर दिया। बहुत लंबे आंसर आई डू नॉट रिक्वायर, 200-300 वर्ड ही हैं जो इस तरह के आंसर हैं, इसलिए लंबा तो लिखना है नहीं आपको कोई। और सेकेंडली जो स्प्रेडशीट वाला काम है, वो एक्सेल वाली शीट भी मैं प्रोवाइड कर दूंगा, जो कि पोर्टफोलियो वाली, उसको भी देख लीजिए। और सेकंड असाइनमेंट आई विल पुट ऑन गूगल क्लासरूम, और एक टेस्ट होगा जो कि मैं आपको बता दूंगा। मोस्ट लाइकली 10th वन के अराउंड होगा, आधे घंटे का या इस तरह का होगा। और क्या यूनिट्स होंगे मैं बता दूंगा उसको। अगर पूरे उसका कोर्स का होगा तो वो भी बता देंगे, लेकिन देखेंगे कुछ कट डाउन कर देंगे, ठीक। अगर कोई, इफ यू हैव एनी क्वेरी यू कैन आस्क अबाउट असाइनमेंट और एनीथिंग। हाँ, MCQ टाइम ड्यूरेशन उसी में होगा, और मोस्ट लाइकली कैसे होगा मैं आपको बता दूंगा, ठीक है। अगर इफ यू हैव एनी क्वेश्चन, और मैं इतना हिंट दे रहा हूँ उसमें, आपको जो बीटा कैलकुलेट करना है, द बीटा विच यू हैव टू कैलकुलेट, यू कैन गो टू याहू फाइनेंस, ठीक है। याहू फाइनेंस में जाए, जस्ट कंपनी की इंफॉर्मेशन यू कैन सर्च, वहाँ दे आता है कि यू वांट टू डाउनलोड डेली प्राइस, तो डेली प्राइस आप एक्सेल में डाउनलोड कर लीजिए, या NSE के साइट पे चले जाइए, तो यू कैन एनी कंपनी corresponding to that you have to get a market। जिसे आपने you have taken निफ्टी ले लिया, आपने उसको भी 1 डेली ले लिया, डाउनलोड कर लिया, या सेंसेक्स ले लिया, इंडेक्स इट इज अप टू यू, जो इंडेक्स लेना चाहें आप ले। अब इसके आपको रिटर्न्स कैलकुलेट करने, ठीक है। ये प्राइस आएगी। रिटर्न का कैलकुलेशन ये होता है कि जैसे प्राइस आज 1 जनवरी मैंने प्राइस डाउनलोड किया, 1 से मान ली शुरू हो रही है सेकंड वीक, तो जो रिटर्न का कैलकुलेशन होता है कि ये, यानी कि प्राइस प्रिवेलिंग ऑन 2 जनवरी -1 डिवाइडेड बाय द बिगिनिंग चेंज डिवाइडेड बाय स्टार्टिंग पॉइंट। एक ऑब्जर्वेशन आपको चला जाएगा, मान लीजिए आपके 200 ऑब्जर्वेशन आते हैं, तो एक ऑब्जर्वेशन, क्योंकि दैट विल बी यूज फॉर कैलकुलेशन, तो यू हैव टू टैली विद द मार्केट। सिमिलरली ये मार्केट विल बी अपेयर द सेम डे। एक बार एक्सेल में आप करेंगे, उसके बाद ड्रैग कर दीजिए फार्मूले को। मैं इतना हिंट दे रहा हूँ इसलिए। और ऑब्वियस बात यह है कि स्लोप का फार्मूला अवेलेबल है उसमें, ठीक। उसके बाद बाकी इंटरप्रेट करिए। जब जा करके दोनों करेंगे, एक्स डिपेंडेंट वेरिएबल है, सॉरी इंडिपेंडेंट वेरिएबल है जो मार्केट है, वाई जो, बाकी आप अपना करिए, ये तरीका है। और
सर,
बाकी
सर उसमें हम रिग्रेशन टूल का यूज करके भी कर सकते हैं?
कुछ भी कर लीजिए। रिग्रेशन में मैं सिर्फ स्लोप इसलिए कह दे रहा था, स्केलिंग की इजी है, आप चाहे तो पूरा पूरा आउटपुट ले लीजिए, दैट इज नॉट, ठीक है, आप तो चाहे पूरा रिग्रेशन रन कर दीजिए, उससे कोई, दैट इज नॉट। और कॉपी ना पूरी एक्सेल शीट चाहिए मुझे, ये नहीं है कि अवेलेबल है बीटा की वैल्यूज, वो आप मुझे दे देंगे कोई, ठीक है। बाकी सेकंड पार्ट तो आपको मालूम ही है, आपको पोर्टफोलियो फार्मूला उसमें स्टैंडर्ड डिविएशन का कैलकुलेट करना है, उसमें डालनी है वैल्यूज, आपको कैलकुलेट करना है।
सर ये जो इसमें ऑब्जर्वेशंस लेनी है, वो नंबर ऑफ ऑब्जर्वेशंस कुछ लिमिट करना है या फिर कितना रखना?
1 ईयर का डाटा मैंने कहा है, 5 ट्रेडिंग डेज जितने होते हैं, हॉलीडेज भी हो सकते हैं, ठीक है। 2 शीट उसमें बनाइएगा, एक तो रॉ डेटा की है, एक जो उसका दूसरी बनाइएगा नेक्स्ट शीट जो होगी रिटर्न्स की होगी, ठीक है, और फाइल उसी के हिसाब से अकॉर्डिंगली आएगी। मिसिंग डेटा अगर कोई है तो अकॉर्डिंगली आपको करना पड़ेगा, लेकिन हार्डली मिसिंग डेटा इतना मुश्किल होता है, आधी दिन हो सकता है मार्केट क्लोज। यू हैव टू मैच इट विद द मार्केट, ऐसा ना हो कि किसी दिन किसी ऐसे स्टॉक को ले लें जो बिल्कुल ऐसा स्टॉक है कि जो कि पेनी स्टॉक है, ट्रेडिंग ही नहीं हुई, तो उसमें मार्केट में आपको नहीं मिलेगा, तो उसमें वेरिएशन होगा।
सर आपने सर वो बेटा कैलकुलेट करने के लिए एक वो मीन निकाल कर वो वाला मेथड भी पढ़ाया था, तो क्या उससे भी करना होगा या सिर्फ स्लोप वाले से ही करके दे दूं?
स्लोप वाले से करके दे दीजिए, वो तो मैंने सिर्फ समझाने के लिए आपको कहा था, है क्या ये
क्योंकि सर स्लोप वाला तो सिंपल फॉर्मूला ही लगाना है बस, वो सेलेक्ट करके।
हाँ तो आप लगा लीजिए, जैसे भी लगा लीजिए, वो भी
चलिए ठीक,
तो समझाने के लिए किया है आपको, इंटरप्रिटेशन इज मोर इम्पोर्टेंट। ठीक है, ठीक है, अगर कोई चीज होगी तो आप मुझे मैसेज कर दीजिएगा, देन आई विल अटेंड टू दैट, ओके, ठीक है। और चलिए फिर मिलते हैं बिहेवियरल फाइनेंस में, लेट अस सी दैट टाइम इज ऑन आवर साइड। बिहेवियरल फाइनेंस स्लाइटली और डिफरेंट है, कंप्लीटली डिस्कशन बेस्ड ही होगा वो पूरी तरह से, इसमें थोड़ा सा न्यूमेरिकल वगैरह, बिहेवियरल फाइनेंस में इतने न्यूमेरिकल्स नहीं है, लेकिन सिचुएशन होगी, ये केस वीडियोस, उससे इंटरेस्टिंग पेपर है, लेट अस सी के हाउ वी रिस्पॉन्ड। 39 स्टूडेंट हैं जो गूगल क्लासरूम में हार्डली 21, 22, 24 मैक्सिमम अटेंड किया, तो क्या कह सकते हैं इसमें, ये तो लेवल ऑफ इंटरेस्ट है। एनीवे we'll see you in next class, as well as we'll meet you on the day of Viva examination. Okay. If you have any issue, any question, anything, you can send me SMS. Okay. If you do not want to share on the mail, you can send it me individually. Okay. I'll attend to that. Okay. So best of luck and see you next semester.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Recording stopped.